All right, so we have a big week ahead, and we started off on a positive note. Probably not as positive as it appears from once you dig into the details and read between the lines. So that's what we're going to do today. We're going to take a look at today's move and see just how bullish it was, and see, okay, what do we expect now heading into some pretty important announcements by the end of the week. Whether it's health-related announcements or stimulus-related announcements or earnings announcements. We're going to take a look at the market posture in anticipation of those and what our expectations are and how they may have changed with today's move coming out of last week's, where we started to have some expectations of a pullback appearing. Today's trade idea is one that's pretty popular. It's been one of our most popular strategies currently in our class portfolios. In my class portfolio, my directional option strategies, because it's the type of strategy that works well right now and has been for the past few weeks and probably will for the next few weeks. So we're going to give you an example of that here for today's trade ideas. So let's go ahead and get started. Today is Monday, July the 27th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see everything's still bullish, and short-term sentiment bounced slightly off of that slightly oversold level, where we just dipped below 20 just briefly, and then bounced up. But the near-term line did not bounce above 50 yet, and we haven't bounced back up to strong highs. And keep in mind too that now we're going to see if we start peaking underneath the market sentiment line, which is not necessarily the most bullish. As market sentiment gets pretty high, it makes that more possible. So for us to maintain bullishness here on a short-term level, we need those near-term peaks to get really high because of how high market sentiment now is. The intermediate line is still above the market sentiment line, and still in the reversal zone. So still a strong bullish posture, dark green shading and the green line still. The Dow Jones Industrial Average had a yellow line here briefly with the 30-day falling a little bit, but its intermediate line is crossed back up above its market sentiment and has short-term sentiment rising. The NASDAQ with a nice little bounce today, NASDAQ 100. Nice little bounce off that moving average and off of its own little intermediate confirmation signal, oversold. Momentum line with a strong bullish posture. Despite the bounce, the intermediate line actually came down and remains below its market sentiment. So that's why I'm not getting, we could still go up to new highs in the NASDAQ here this week, especially with earnings coming up by the end of the week. But I'm not going to get too wrapped up in the bullishness of that. And start loading up again on new positions in that space, just because again that intermediate line is staying below the market sentiment, which is not the most bullish. The Russell 2000, you can see it bounce back up off of its intermediate confirmation signal from Friday, oversold momentum line bouncing up, the intermediate line bouncing above its market sentiment and getting into the upper reversal zone. So you can see it's still. It's showing dark green shading and a green line, but you also notice that it's not even more close, even to that June 8th high point. The June 8th high point that we hit there's the June 8th high point. Was the June 10th for the NASDAQ. We're actually well up above it. We are still below the June 8th on the Dow high, and you can see we have been flirting with breaking through the June 8th high on the S&P. So it kind of just shows how much the Russell and the Dow, for that matter, is lagging behind. But all these indexes still trading between 0 and 23%. So until you start pushing the 0% line up, or until you break the 23%, you're just in noisy periods here, and that continues to be the case for not just the NASDAQ 100, but also the S&P, which actually has been pushing its 0% line up, and still has that old high point from pre-COVID declines that we are just, this acting as this kind of magnet to try to pull us up before we ever get the exhale that we've been anticipating with what is now going on a 4-month intermediate run here. you can see, beside from the S&P, the Dow and the Russell are showing strong bullish postures. And just remember, the Nasdaq's the only one that's showing light pink shading right now. The only one. It dipped slightly below it on Friday, and even with, like I said, today's bounce, that's a lot of light pink shading it's been showing here. When things really kind of grind, right? When you're really bullish and you turn right back down, you don't get a lot of light green shading. But when you're bullish and you start to get a lot of light pink shadings, that's kind of telling us how much more we have left to go here before we get dark pink shading and a red line. So we're getting a lot of that. We're not getting any yellow lines because we're still well above the 30-day moving average. But the frequency of the light pink shading, in addition to the intermediate line below the market sentiment line, just tells you don't get too worked up on any kind of rallies here this week, as we're still showing significant signs of what could be an intermediate pullback even by the end of this week. As always, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon right here. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit the thumbs up icon. That tells us that you liked our video and that you want us to do another video again tomorrow. It's a quick way to give us feedback. If you like our videos and you want to let us know, click that thumbs up. Right? You can do that right now. If you don't like our videos, of course, you don't have to click on anything. Also, while you're down there, comment. What did you get out of our videos today? What questions or comments do you have? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. And join our Market Outlook Facebook group that we've created. Alright, if you're watching us here on our blog, you can check out other things like our Market Outlook live video. So earlier today at 3:30 Eastern Time, I did a live video on YouTube where we review all the trades from previous Market Outlook videos that I've done. We also put on today's trade idea before the market closed. We always do that here. There's a link. Just click on that play button. It will take you to the page. You can also mouse over and get to it there. Again, that's available for all of our subscribers, our monthly plus subscribers, as well as our premium subscribers. Our monthly plus subscribers also get access to all of our trading rooms that we have. Go to trading rooms to see a calendar of all of our classes. We do 8 a week. And our premium subscribers get access to all of that too, in addition to the 2 Q&A sessions we do a week, as well as all of our tools and our community access, including our class forums and all the custom content we create for our classes. Also, while you're down here, click this heart. That opens up this new window. You can hit the like button right there. Click on this thumbs up. It takes you to today's Market Outlook Facebook post. Hit that like button right there. We really appreciate that comment, Sophia. The more you do that, the more it benefits us, because the more likes these posts have, the more Twitter and Facebook will promote our content to all of our followers on those accounts. It benefits you too, because they will promote content in your timelines that from the accounts that you engage with. So we try to make it really easy for you to engage with us here. Also, while you're on this page, this blue button at the top of the screen here, you can subscribe to our site for free by clicking on that blue button there. All right, let's take a look at the charts again here. So let's take a look at this week's Heikin Ashi candle as the PPO continues to push higher. We don't have a lower high as of yet. We do have kind of an equal close, but it's a much smaller range. Today's open is at 31.93. We're at 32.39, so we're not in any danger yet of a bearish candle. But look at the Nasdaq. Look how small. Look at last week's big transition candle, and so far this week's very small. So it kind of gives us an idea that, again, even if we go up this week, we're headed. There's a good chance, especially look at how many weeks in a row we've been bullish without any kind of weakness. That's to kind of give you an idea over here. After we had the transition candle, we had 1, 2, 3, 4, 5, 6, 7. Let's see, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17 weeks before we turn bearish here, not including the transition candle here. Then we've had since then 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17. So you can kind of see we're getting pretty relatively long in the tooth, and this isn't a log scale. Let me give you a log scale chart. We're getting pretty, like, we've been up here for a while, similar to this move, and you can see even similar to this move. It's kind of hard to stay too bullish for that long without a few red candles here, and again, at least, which in this case, if we were to get to a 38% retracement, would be to the 200-day moving average by the time we got there. You can see the Russell 2000 trying to get bullish here. It still hasn't got that golden crossover, but we're getting a lot closer. And the Dow just barely got it last week and continuing in the green shading again this week. Let's take a look at the 3 green arrow chart. You notice we got one red arrow, so we finally got a red arrow on the MACD, which again, to give you an idea, I don't know why that keeps popping up, but you get the idea here that the MACD is crossed below its moving average, stochastics also crossed below its moving average, and N is now breaking below 79. You don't get the red arrow there until you get back below 75. We did dip below the 8-day moving average on Friday before bouncing back up today. So we'll kind of keep our eyes on that. The Qs have broken below the 17-day. So again, you either bounce back up or you don't, and today we did. We bounced right back above it and above the 8 days. So kind of keep an eye, considering how bearish stochastics is, dropping below 50, and how bearish the MACD is, being below its moving average for this long. Again, don't get too worked up on any moves higher this week. We could actually, like I said, we could still go up to new highs, but we're still kind of in this bearish mode on these charts. You can see it on some of these other charts as well, where the not as bullish anymore on the RSI. And even over here, we're on the Nasdaq, which had been more bullish on the RSI, is broken back down below 60, and its CCI had broken below negative 100 on Friday. You take a look at it, their Bollinger bands here, and you can see QQQ is seeing if it breaks through here, then you can see where the run to the 23% line is the next move, and the 38% line, there's another big volume node there. So that's the volume situation that we have going on, and this is the volume situation we have going on the S&P, which not only is still trading between 0 and 23, but it's above that 78%, so maintaining some relative bullishness, even if, according to the Bollinger band width here, %B down at the bottom, we're not as bullish as we have been. Alright, let's take a look at the intraday chart here. We'll see how we bounced up here on the S&P, filling in the rest of the gap from Friday morning's decline. We filled in a lot of it on Friday, but filled in the rest of it today. Again, no gaps here to the downside. Again, that's why I'm not too worried about the downside moves. We're not getting any significant run, unless if we gap down, say below last week's low point, for whatever reason, tomorrow, whatever. If we gap down below that low point and then we stay down there, then that would be significantly bearish. But again, very unlikely to happen. You can see the gaps to the downside that we've been getting here have been, let's see, down here, very, very minimal. We haven't had a single standard deviation gap to the downside since back on June the 11th, after we had the June 8th peak, right? So there was some, let's see if I come over here, right in here. So that was one of our biggest downside gaps. We have since filled that in, obviously. But for a little bit of time, that was a little concerning in terms of the potential for runaway gaps where we start an intermediate trend that goes down and stays down for a while. Obviously not the case. So maintaining some positive back above the point of control for the 4-week. Still kind of flirting. It's still inside the value area. Most of the value area is down below. Most of the value area, it's up in the upper half. That's going to change. Remember, by the end of this week, the lower end of the 4-week range is going to be a lot higher. So, if we don't start to push the high up higher, we're going to end up with a pretty, pretty low range. By the end of the week, we'll be right about here, about 310. That's going to be a pretty small range compared to where we've been in the past, how big it's been in the past. So just kind of keep your eyes on that. It's going to be very easy. I'll probably bring the midpoint up into this area, basically to last week's low point. That if we, if we're trading down in this area by the end of the week, we could be in the lower half of the 4-week range before we even know it. Let's take a look at today's volume and trading range, which continues to be really, really light. Today's volume, 48 million shares. We haven't had 48 million shares in a long, long time. And the trading range, again, not worrying about any gaps here. The trading range, about half of the ATR. And if you look at, again, where these are coming in, we're down to 1.5% now. The ATR is 1.5% of the price. That's a good level. Remember, to get below 1%, we need the ATR to get below, 3.23 now. We're just under 5. So keep your eyes on that for us to continue to get more bullish. And you can see the volume at 48 million today is even that far, much below where the average is here. And the average should, as we go up in price, should be coming down because of the amount of money that's going into this. The VIX, interestingly enough, did not go up, continue up, and instead is down even lower than we were last week on a relative basis down here at the bottom. So we continue to show really, really low volatility in very small ranges. Like we had a little bit of a bounce in range the last couple of days of last week and then today. So kind of keep your eyes on the rest of this week, especially heading into Friday, where we have all those earnings coming out Thursday after the market, Apple and Facebook, among others. So I wouldn't be surprised if we don't get really sideways for the next few days in really small range, short with no real significant movement one way or the other until we get to Thursday night, and until we get this at the end of the month too, where you have the geopolitical issue, at least here locally, with all the stimulus that's set to expire on August the 1st. So we'll see if any of that ends up affecting things, along with these major tech companies that are showing earnings at the end of the week. It could make for a really boring Tuesday, Wednesday, and Thursday ahead of those important events. So to summarize our technical outlook, we're still bullish. We're not nearly as bullish as we have been. There are some bearish signs, but we're not too bearish either. And there's a pretty decent likelihood that we get potentially a divergent high point this week if we continue higher through these earnings. More than likely a very small range in equities and volume and volatility until we get to the very end of the week, where things can then start to take off from there. So, but again, any bullishness we get, I wouldn't expect to last for too long. At some point in time, we'll get that exhale, and because of how mature the intermediate run is, right? We are, now 3 months in, going on almost 4 months in, and we can go 5 months, and this exhale might be postponed for a few more weeks. And just know, the longer we go up here for the next week or 2 or 3 or 6, the longer we go up, the more uncomfortable the exhale will be, as we've seen every time that we've had a 4 or 5 month intermediate run. They've always ended very badly. 3 months, it's pretty uncomfortable. 1 to 2 months, no big deal. The typical average is 1 to 3. But once we go longer than average, once we go longer than normal, and we're 4 or 5 months without an exhale, then it will make it very uncomfortable for a lot of people. It won't be that big of a deal, because we should be getting less bullish now as we get more mature in this run. Doesn't mean we can't be bullish at all. It just means that we are less bullish. So what do you think? Do you agree with that assessment? Do you disagree? Let me know, especially if you disagree, down in the comment section below. What are you looking at that either makes you a lot more bullish than our posture here, or makes you a lot more bearish than what we're seeing? All right, now let's talk about what's driving the price action. Man, the biggest mover of the still hasn't updated this chart yet. The biggest winner, the biggest mover here lately continues to be the dollar in the wrong direction. It's been dropping like a rock. You can see, look at the breakout move there on the euro. Let me give you some context on that trend line. I have to give you even more context on that trend line. Coming all the way down. Let's just go back as far as we possibly can. Coming all the way down these highs from 2008 all the way to here, you can see the breakout on the rally. Now, of course, it's just one day into 1 week that we've had this breakout, but still, look at the bullish dark green shading, green line that we have going on here, and the daily chart continues to also show strong bullish. In fact, the market sentiment's close to getting up above 80. Very, very strong move. It also is very pretty darn bullish. In fact, if you look at how far above the 30-day moving average the euro is right now, if you were to take a look at current prices here compared to the 30-day average, so really simple. To kind of give you an idea, we're 3% above the 30-day moving average. That's extreme. At least for the past year, that's a significant move. If you take a look at, like, say, the last 10 years, the only time that we've had kind of significantly bigger than where we're at here is back on this short little run in 2015 in August, where it spiked up really quickly before coming down. This is a little different because it's, we've been trending bullish here for so long. We've had a few little spikes. There's the coronavirus spikes. But it just goes to show just how strongly bullish it is. Don't be surprised if the dollar's weakness really starts to slow itself down. Here's the ETF for gold. And you can see how high it is. Very similar. It's the highest it's been above the 30-day moving average is back here in early 2016. It kind of went sideways for a while, but didn't go down. And then you can see over here in 2011. That's the other time that we were this bull. In fact, it was actually a lot more bullish. It was up in the 10% range, and we're just in the 7% range. We haven't quite got to the 10%, but still, pretty darn bullish on gold. I did share this out on Twitter. If you follow me on Twitter, you saw this here. You notice that a lot of people have been talking about how bullish gold is, and rightly so. We are approaching these 2011 highs, and that was a pretty bullish period. But that was a culmination of multiple years, 2009, 2010, and all the way through 2011. We have been bullish for that long. We've just been bullish on gold here since 2009, essentially. We're just starting to run. But if you look at gold relative to stocks, it's a completely different story, right? In 2011, we were a lot higher than we've been on a significant downward trend all the way to the beginning of this year. The beginning of this year is where we had a little bit of a spike here, and we kind of finally broke out and changed the trend. We started in 2016, but that didn't quite take nearly as much as this one did. A bigger move to change the turnaround. We have since pulled back, and now the MACD and the PPO on the weekly chart here are turning back up again. So gold might be really overbought on the short term, and it might have some weakness on a day-to-day basis, considering how bullish it is. But when you look at how bullish it is relative to stocks, we're not even close to being extremely overbought. We've been a lot more bullish than this in the past. And it's got a long ways to go. You can see from 2005 up to the 2008, the end of the financial crisis, and then of course through 2011, we were at 1.5 times the SPY, and here we're just half. The gold GLD is actually half of SPY. So when you look at it on a relative basis, it's pretty oversold compared to some of these other asset classes. So keep that in mind, in addition to this idea that the yields just aren't going anywhere. So we're still, today was a little bit of a bullish move, and one of the bigger bullish moves that we've had in a while, but we still have very strongly oversold market forecasts here, and the same thing on the weekly chart. We still got a long ways to go before things really turn back around and get positive to where we have a positive trend. Again, rising gold with rising inflation expectations would coincide with rising yields. And that's generally bullish for risk appetite. So just kind of keep that in mind, especially when you combine the fact with commodity prices and like crude oil, which are just starting to move higher, and they're kind of overbought too in the very short term, to the point where they might kind of struggle. But you can see too their potential in the longer term to really get going to the upside, both commodity BC and then of course USO, which has its own issues here. So there's a lot of room to the upside for risk appetite. We are hardly in an extreme overbought condition in the least bit. In fact, when you look at this same chart and you look at commodities relative to SPY, again, very similar scenario here where we are just extremely bearish and still haven't really gotten going, trying to break above the 50-day moving average of this relative strength line. So this is lagging, and it will peak after stocks peak for good. So you can see stocks peaked in 2007, then commodities really took off. So it can be lagging, but it also shows that we're not mature yet in this bullish trend. And while we might get some kind of intermediate pullback here, there's opportunities for this lagging asset class to really get going and turn positive again. And then even then, that would give us time before things really hit the fan in terms of a real bear market. So we've got a lot of opportunity for risk appetite going forward from here as we transition from cyclical areas to more dollar sensitive areas, like energy, like materials, like crude oil, like gold, like international stocks that can do really well. U.S. stocks can go up too, and will go up generally speaking when the dollar goes down, but you'll have some really good opportunities in some of these other areas. Let's take a look at now how things performed here today on the sector rotations. Let's go to July. Here we go, and then let's go to 10 minutes. So again, with the dollar continuing to go down, you can see materials staying strong. Technology XLK was really the only thing that bounced today. So you don't have the same bounce in XLC, which is a lot of those like Facebook, Google. Those names are that are in there not bouncing up as much. And then of course you can see some other areas continuing to show weakness. Utilities showing weakness and financials showing weakness. And that's not your typical relationship. Usually these are two interest rate sensitive sectors on opposite sides of the spectrum. So the fact that they're both down, along with energy, which with energy being down as much as it was, with materials being up, shows again, we're still not quite in, we're still in kind of volatility mode where you got some big moves here and some big moves there, but we're not into established trend grinding higher mode where you'll see materials and energy go up together, where you'll see financials go up with them, and safe haven sectors all coming down here, and your cyclical XLC and XLY and C staying together. And so today was just kind of the more days where those are kind of all broken up, like today is even as up of a day as it was. It just goes to show this isn't like a trending up day. This is just more of a you just had the biggest names that were up. In fact, if you look at if you come over here and you look at the biggest market cap stocks, let's see here. It looks like I don't have them here, so let me bring these back up and look at market cap. If you look at the biggest market cap stocks here, and let me get rid of the 52-week high and low. Don't need those on there. There we go. Don't really even need the high and the low, but we'll leave them there for now. Here's our biggest market cap stocks, and they were all up, pretty decent size today. Whereas on the flip side, on the downside, you don't see. In fact, we have some big losers today on the downside. Some of these big losers that were losers before continuing to lose and show, and only sporadic winners. So you can see the big difference in the big large cap names that are doing so well continue to do very well. In fact, if you look at what the big winners are outside of healthcare stocks that are all kind of banking on this vaccine news that's coming out there, there's a lot of information technology as well, just not the typical that you would expect. Some names that aren't as popular, they're showing the big winners here today. Alright, so let's take a look at our trade idea of the day. We're going to take a look at FedEx. FedEx had a nice little bounce today. Excuse me, let's come over here. A nice little bounce today, coming off of sideways action, kind of breaking out close to new 52-week highs. Where we still got these kind of moves from back last fall that we have to work our way through. But the market sentiment line's rising almost above 80. The posture is strongly bullish. The near-term line came down, but only hit kind of the midpoint of the range before popping up. Very good, strong jump here in terms of getting, we've been above 60 this whole time after the post-earnings breakout. We're still right around that 100 area. If you look at its Ichimoku cloud, we've got a strong trend. We're riding above the green line very easily, well above the cloud. You look at the DMI, still showing strong trend, but a mature pattern on the DMI. You can see the ADX is almost up above, almost up to 40 here, with the positive and the negative lines as extremely far away from each other as they are. And then you look at the two-line versions here of this chart, and you can see, okay, well, we were trading around that 8-day moving average. The MACD is already high, so there's not a whole lot of upside. I mean, this is a nice little bounce, but not a whole lot of upside to this, but also really not a whole lot of downside either. You can see from a Bollinger Band perspective, we're breaking out above the value area, and the point of control is right where we were kind of stalled there for a while post earnings. So there's not a whole lot of downside either. So when you don't have a whole lot of upside, especially with the posture as mature as it is from a broad market standpoint, and you don't have a lot of downside either, then that sets us up to do an iron condor spread, where I'm going to sell the 160, buy the 157.5, sell the 182.5, buy the 185. That makes it look like this. Position sizing for a normal position size, so I don't have to worry about earnings going into August. And then those break-evens there, you can see where they are on the chart. The break-even on the downside is kind of protected by that point of control. Very strong support down below there. And then we've got room to the upside. And again, there's my risk right there for August expiration. We've got room for it to kind of work its way around here, and a pretty decent return for the risks that we're taking. So a good opportunity to do a sideways trade on a stock that has upside, has a great bullish chart, but not as much upside, especially with the mature broad market posture. But also, because of how bullish it is, doesn't have a whole lot of downside either. So we'll take advantage of the neutral pattern. With a neutral strategy. All right, well, that wraps us up for today. As always, you heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen that goes to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going here in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video down below, follow me on Twitter for more content between videos, and join our community at marketscholars.com, as well as our Facebook group that we've created. Have a great rest of your Monday night, everybody, and we'll see you all next time.